Silver has been treated as a peripheral asset in public markets while being monitored with far more seriousness inside institutional risk rooms, and that disconnect is starting to show stress in places most investors never see, which is where this story actually begins. At the institutional level, silver is rarely discussed as a trade, and more often as a variable, something that sits quietly inside models designed to measure supply fragility, currency credibility, and industrial dependency. And when those models start flagging unusual behavior, it doesn't show up in headlines first. It shows up in adjustments that look almost invisible until they're not. Behind closed doors, the question isn't whether silver is cheap or expensive. It's whether the market is still functioning as a price discovery mechanism or merely as a clearing system for paper exposure. And recent positioning suggests that distinction is becoming harder to ignore, which introduces a problem that doesn't resolve cleanly. Historically, institutional demand for silver hasn't moved in straight lines or dramatic bursts. It accumulates quietly through allocation tweaks, inventory decisions, and hedging frameworks that only make sense over multi-year horizons. And when those frameworks begin to shift at the same time, the signal isn't obvious, but the implications can be. Under the surface, long-term price models aren't reacting to daily volatility or retail sentiment. They're reacting to changes in correlation, substitution risk, and confidence in forward supply assumptions. And when those inputs start drifting together, it usually means something structural is being reassessed. Right now, available data suggests that reassessment is underway, not as a bet, not as a narrative, but as a contingency. And the difference between those three is where most misunderstandings begin, because contingencies don't announce themselves until they're already in motion. This is where the silver market stops behaving like a chart and starts behaving like a system under quiet review. And what institutions do next depends less on price and more on whether the underlying model still holds. What complicates the picture is that institutional silver demand doesn't express itself through obvious buying pressure in the way equity investors expect. It shows up through shifts in how silver is treated relative to other inputs, and those shifts are already visible if you know where to look, even though the surface market remains calm. In long-term allocation models, silver isn't isolated. It's paired against energy costs, base metals, and currency stability assumptions. And when those relationships begin to loosen, it forces risk desks to reweight exposure, not because silver is attractive, but because the surrounding structure is changing. Reports indicate that some institutions are no longer modeling silver primarily as a monetary hedge or an industrial commodity, but as a constraint-sensitive asset, meaning the focus has moved from demand growth to supply reliability, and that change alters price expectations in ways that don't show up on short-term charts. At the same time, derivative markets continue to absorb volume without reflecting physical tightness, which creates a divergence that long-term models don't ignore, because persistent divergence tends to resolve through availability, not sentiment, and that resolution rarely favors stability. What's notable is how quietly this is happening, with no urgency in public commentary and no coordinated messaging, just small, consistent adjustments in how silver exposure is structured inside larger portfolios, and consistency is often the tell before intent becomes visible. Historically, when institutional models stop relying on mean reversion and start emphasizing tail protection, it signals that confidence in equilibrium is weakening, and silver has entered that category more often than most realize. This doesn't mean institutions are predicting a price event. It means they're preparing for a scenario where the current pricing framework no longer explains behavior. And once that preparation begins, it rarely reverses without consequence. The pressure point in these models isn't speculation or demand growth, it's substitution, because silver occupies roles that don't always have clean alternatives. And when substitution assumptions weaken, the margin for error inside pricing frameworks narrows faster than most observers expect. In industrial planning models, silver is often treated as a flexible input on paper, but procurement behavior tells a different story, one where long-term contracts are being prioritized over spot exposure, and that preference signals caution rather than confidence, which changes how institutions assess future availability. Available data suggests that inventories used for buffering volatility are no longer being modeled as surplus in the same way, especially when adjusted for industrial drawdowns that don't reverse cleanly. And once buffers are reclassified, pricing logic has to adapt whether markets acknowledge it or not. At the same time, Long-duration models are showing increased sensitivity to policy risk, not because of any single regulation, but because silver sits at the intersection of energy transition, defense manufacturing, and infrastructure renewal, and intersection risk compounds quietly. What's emerging is a market that still clears trades efficiently, but transmits less information than it used to, and when transparency declines, institutional models respond by increasing optionality rather than exposure, which sounds neutral, but isn't. Historically, optionality expansion precedes repricing phases not because of demand surges, but because risk tolerance contracts, and silver has a habit of reacting sharply when tolerance tightens across multiple sectors at once. This is the stage where price can remain stagnant while structural tension builds, and that tension doesn't dissipate through time, it accumulates, waiting for a release mechanism that rarely arrives on schedule. One of the least discussed elements in institutional silver models is time, not as a forecasting tool, but as a constraint, because silver markets tend to function smoothly until they don't, and when timelines compress, adjustments become nonlinear. Long-term demand projections haven't surged, but the confidence intervals around them have widened, and widening ranges force institutions to plan for outcomes they don't expect but can't ignore, which subtly shifts how silver is valued inside portfolio stress tests. In parallel, lending and leasing assumptions have grown more conservative, not because of visible shortages, but because counterparty behavior implies a preference for control over yield. And when that preference spreads, liquidity becomes conditional rather than assumed. Market behavior implies that some institutional players are treating silver less as a tradable asset and more as a balance sheet anchor, something held to stabilize exposure elsewhere, and anchors don't move often, but when they do, the system feels it. Historically, when an asset transitions into that role, price discovery slows before it accelerates, creating a misleading calm that tends to frustrate short-term observers while long-term models quietly adjust around it. What's notable is that these adjustments don't require consensus, they only require enough overlap between large actors to alter marginal behavior, and marginal behavior is where price eventually responds. This is where silver's current stability becomes less reassuring and more ambiguous, because ambiguity is exactly what institutional frameworks are designed to price, even when markets appear indifferent. Another layer of pressure comes from how silver is being treated inside cross-asset correlation models, because those models are starting to flag behavior that doesn't align with traditional inflation or growth narratives, and misalignment is something institutions take seriously even when it's subtle. Silver has historically oscillated between monetary sensitivity and industrial sensitivity, but recent market behavior implies that neither framework is fully capturing what's happening, forcing long-term models to treat silver as its own category rather than a derivative of something else. When that happens, benchmark comparisons lose usefulness, and valuation becomes more about internal consistency than external reference points, which reduces reliance on market price as a signal and increases reliance on internal stress assumptions. At the same time, capital allocation committees aren't asking how much upside silver has, they're asking what breaks if silver behaves differently than expected, and that question reframes exposure from opportunity to insurance, which carries very different sizing logic. Reports indicate that some institutions are embedding silver into broader resilience frameworks tied to supply chain durability, meaning silver exposure is justified even if price underperforms, and once an asset earns that justification, it's harder to remove. Historically, assets absorbed into resilience planning don't see immediate price response, but they do experience reduced float over time, and reduced float has consequences that unfold unevenly rather than all at once. This is the phase where long-term price models begin diverging sharply from near-term market behavior, and that divergence doesn't stay theoretical forever. It looks for a point of reconciliation. What makes this divergence more fragile is that silver's market depth isn't as robust as its derivatives footprint suggests, and institutional models are sensitive to that imbalance because depth matters more than volume when conditions change. Long-horizon stress testing increasingly treats silver as a potential transmission channel rather than a passive asset, meaning shocks elsewhere are modeled to flow through silver rather than around it. And that reclassification alters expected price paths even without new demand. At the same time, institutional confidence in smooth inventory mobilization has softened, not due to visible constraints, but because logistical assumptions are being discounted more aggressively, and discounted logistics raise the implied value of certainty. Available data suggests that some pricing models are now incorporating higher time-to-delivery penalties, which don't move spot prices directly but reshape forward expectations, and forward expectations eventually influence real behavior. This is where paper liquidity can mask physical sensitivity, creating a market that looks stable under normal conditions, but reacts disproportionately when timelines tighten and institutions are building that asymmetry into their planning. Historically, when asymmetry becomes embedded in models across multiple desks, the market stops being priced for equilibrium and starts being priced for resilience. And resilience pricing doesn't announce itself through rallies. The risk isn't that silver suddenly spikes, it's that the market slowly loses its ability to absorb pressure without repricing, and once that absorption capacity erodes, outcomes become harder to manage. The final pressure comes from how long-term institutional models deal with uncertainty, when it becomes persistent rather than episodic, because persistent uncertainty forces structural decisions instead of tactical ones. And silver has quietly entered that category. When uncertainty lingers, models stop asking what silver should be worth and start asking what role it must serve if other assumptions fail. And that shift transforms silver from a price variable into a system variable, which carries very different consequences. In that framework, demand doesn't need to rise sharply to matter. It only needs to become less price sensitive. And available behavior suggests that price sensitivity is already declining in certain institutional channels, even if the broader market hasn't noticed. At the same time, exit assumptions are being revised, not because institutions plan to sell, but because they're less confident that exits would be orderly under stress. And reduced exit confidence increases the implicit value of holding through volatility. Historically, markets misread this phase as apathy or stagnation, when in reality it reflects a transition from optional participation to embedded necessity, and assets in that transition rarely behave predictably. What emerges is a silver market that still looks liquid, still trades actively, but is being quietly reclassified inside long-term price models as something that must be owned under certain conditions, not traded around them. And once an asset crosses that line in enough institutional frameworks, the question stops being whether price will change and becomes how the market will respond when those frameworks are finally tested. Would you like me to write the conclusion?